This is Unit 5 in my entrepreneurship class, and it's all about pricing, costs, revenue, and profit. The objective is that students will calculate cost set pricing, identify revenue streams, and determine whether their business can generate a profit or not. By the end of this unit, my hope is that my students will be able to answer this question. How do entrepreneurs determine if their business is actually going to be able to make some money? So we always open with something that's just kind of a hook here, and here's where I start. If you sell something for 10 bucks, do you actually make 10 bucks? This gets students starting to think. Some of them will say yes. Some of them will come back and say, well, it depends on what it is that I am selling. And it also depends on how much it costs me to buy that thing that I'm selling. And that's where we start to get into some of the definitions early on. We have to just quickly outline that revenue is not profit. If the example in that case was revenue of $10, then the costs need to also be accounted for as well: rent, supplies, labor, materials, marketing, and more. How much of the expenses were actually needed in order to create that one individual unit? Whatever is left is profit. Hopefully, there's something there. I give them three words to know. First are these definitions: revenue, money coming in from customers; costs, money going out to run the business; profit, what's left after costs are paid from that revenue stream. And so I give them an example. If you have a lemonade stand, and I always give them something that they can conceptualize and really relate to. I think everybody can break down a lemonade stand. If you sell one lemonade for $5, that's your revenue. The ingredients and supplies might have cost you $3, and you would have calculated this by, let's say you made a pitcher of lemonade and you sold it for X amount, or you created it for X amount of dollars, and you know how many units you can create with that one pitcher of lemonade. We can now calculate how much the costs were for that full pitcher of lemonade and then also that individual unit. So what's left in this case? $2 in profit. So to define one unit, I give them an example. And in this case, I'm using a coffee shop. The customer orders one drink and pays at the counter. It's their signature drink. It's the specialty drink. It's whatever they are known for. It's the thing that everybody goes there for. It's why Yelp is raving about this particular business. What exactly did that customer buy? Well, they bought the signature drink. Look, we could get into the ins and out and say, well, what if they got a tea? What if they got a coffee? What if they also got a pastry? My intention here is to outline one individual unit because for the scope of this class, we are covering the breakdown of pricing as well as revenue, profit, and everything else in between for one unit. And if students wanted to go above and beyond and extend it out beyond that, by all means, I would encourage that. But as long as they can grasp the one unit concept, we're in a good spot. So one purchase, one transaction, be specific. And so in my class, with the full semester project that they are choosing, I make sure that they limit their product or service down to only 3 items that it is that they sell, so that we don't go overboard here. We're not the Cheesecake Factory with 100 pages of menu items. We're more like the In and Out, if you will, the burger. You can get a burger, a shake, and fries. That's about what you can get. Obviously, there's variations, but you hopefully get where I'm going with that. So now we need to apply it to a different business. Choose a business that you are familiar with, not your own yet. Again, my students follow this for the full semester. If you are just picking this up as an individual unit, one off, by all means, just kind of follow along. But I would encourage you to have your students, if you're teaching entrepreneurship or intro to business, to actually create an intro or a business plan of sorts to follow a business for the full semester. If you do follow one of my full semester units, you can, or full semester bundles, then all of that work is included in there as well. So back to this. We want to apply it to a different business. Choose a business you're familiar with, not your own yet. What is one unit that that business sells? For example, a barbershop. Maybe their signature thing that they're famous for on TikTok is a low taper fade. It's one purchase, one transaction, very specific. Now it's your turn to define one unit of for your business. So what is your business? If my business is a smoothie shop, well, it's my signature smoothie. If my business is specifically a landscaping company and I do a lawn cut, I probably have different square footages that are determined based on the pricing. But for the most part, I'm cutting your lawn, right? That's one unit, one item purchased. If it's a car detail, it's one car detail. Add this to your guided notes. Also worth noting, all of my units do come with guided notes because by the nature of the content that I teach, it is lecture heavy. As such, because it is lecture heavy, there are notes to keep students engaged while I go through all of these slides. What you are actually building here is this. When my business makes one sale, what actually is happening financially? Well, first we need to define, well, what is that one unit? It's a specific item. It's one purchase, one transaction. That is the foundation for all of our pricing decisions going forward. Now we need to break down the economics of one unit. We need to figure out how much are we going to sell it for, what is the cost to produce or deliver one unit, and what is the profit that is left per unit after that sale. What are the monthly costs? After understanding one unit, we're going to zoom out and list variable expenses as well as fixed expenses. Those are coming up soon. So, first step is within the guided notes. And if you're following my full semester, I give you this full template slide deck that students complete for their business. And so they would fill in all this information here. This is also included in an individual unit if you were to purchase that. So, what is one unit? This is just the top portion of this graph that you can see. We're not filling in every single thing yet. This is the end goal for Unit 5. By the end of this, I want to be able to answer all of this. So, step 1, define one unit. Step 2, what is the economics of it? Step 3, profit per unit. What happens financially when that one unit is sold? This is what we're creating for your business. Here's an example of it. This is a simplified example of one sale where the business will have different numbers, obviously. And in this case, it was a student of mine that created a pair of shoes that was connected to a motor with wheels underneath it and GPS capabilities that effectively turned your shoes into cars. I believe, if I'm not mistaken, the company was called Scoot Scoot, and it did win some money in the local competition. Anyways, moving on. So first, we figured out the selling price. If we know we're selling it for $300 and we know how much it costs for the variable materials, as well as the cost of labor, estimated other variable costs, we can figure out the cost of goods sold, the COGS, is $190. We take our $300 selling price minus $190 in cost of goods sold, leaves us with a profit per unit of $110. Now, this is just an example slide. I'll walk you through how to do all of these things. Before we get too far, we need to define a few things. Variable expenses versus fixed expenses. Variable expenses, just like in math class, it's the thing that can change. We can adjust it. It's the X, it's the Y, it's the thing we don't know yet, but we can adjust it. It's something that changes each month. I use a certain amount of gas in my car each month, and it's a little bit different each month because maybe I drove a little further. Maybe gas prices went up a little bit. There's things that change versus, for example, my mortgage on my home doesn't change each month. That is a fixed expense. If we're a business, we can think the same way. If I have a hourly employee, perhaps that hourly employee works more hours in one day than they do another day. So their monthly expenses as an employee change versus a salaried employee where their expenses are the same every single month. We know exactly what we're going to be paying them. So the example is this: variable are costs that change based on how many units are sold. Fixed expenses are those that stay the same each month and they exist even if no sales are made. You can see I gave you some examples and told you what the key idea is here. So, big picture on all of this for the variable expenses is if you sell more, the total variable costs go up because I need more materials or I need to use more energy or whatever it is. The less that I sell, the total variable costs go down versus the fixed expenses. If I sell 0 units, my fixed expenses remain the same. If I sell 100 or 1,000,000 units, my fixed expenses remain the same. Next, we are going to list out our business's variable and fixed expenses before converting them into per unit costs. So I have my students then take some time in their guided notes, list out all their variable expenses, list out all their fixed expenses, and then come up with some rough numbers as to what it is that they'll be filling in. This is the table where they fill that information in, again, included in those guided notes. I have them document all these expenses, and this list could be exhaustive, but we're just really using this as a rough template, an idea, a starting point for us to get some ideas about what are the expenses going into operating and creating that one individual unit. Now that we have our fixed and variable expenses for 1 month, we now move on to calculating the cost of labor per unit. So labor is a variable expense, assuming that these are hourly employees. When it increases, and this increases each time a unit is produced or a service is delivered. Labor cost per unit is equal to the hourly wage times the time per unit. So, for example, if my employee earns $20 an hour and it takes them 1 hour to create the thing, my variable expense is $20. It's $20 for that one item to be made. The labor calculation example is, again, $20 an hour. If I was to do this for 30 minutes, that would be half of an hour. The labor cost per unit would be $10. So if you pay somebody hourly only when work is done, labor is variable. If someone is paid the same amount every month, which is called salary, labor is fixed. Now it's time to calculate labor costs per unit for your business. Consider the labor to produce 1 unit for your business. Think about your hourly wage. How much will you pay your people? Time to produce or deliver 1 unit. If we're detailing a car, maybe that takes you 2 hours. Maybe if I'm, making, I don't know, a taco takes me a minute and a half. Well, how many minutes and a half are there in 60 minutes? We can do that math. The formula is as follows: your labor wage times the time per unit equals your total labor cost per unit. Now, again, if I was to do that $1.50 taco example, we would have to do a little bit more math. We'd have to figure out how much of your hour of 1 minute and 30 seconds is actually part of your hourly wage. That would get more complicated to stick with the basics of using some big whole round numbers. So your turn to identify other variable costs per unit comes up now that we've got the labor. Consider the non-labor costs that occur every time you sell one unit of your product or service. These costs increase when you sell more units and decrease when you sell less units. Think about the materials or the ingredients per unit, the packaging per unit, the shipping or delivery, the transactions on platform fees. For example, if I have credit card fees that come in every single time that I swipe a card, advertising, marketing, the other variable costs per unit, and other things. These numbers will all be added up on our economics of one unit table, which is right here. So now that we've defined one primary unit at the top of this table, the next thing that we need to do, and notice that I'm actually I leave my sales price till the end. Some students jump to it and put that right at the beginning. But at this point, we've now determined what our cost of variable material expenses are per unit, as well as our cost of labor. And now as well the estimate of other variable costs. So we can calculate our profit per unit by doing the following. Identify how much you're going to sell each unit for, calculate your total COGS, cost of goods sold, per unit by adding together all the costs. Now that we have how much we sell it for minus all of our cost of goods sold, we're left with our selling price minus COGS equals profit per unit. This is how much money is left over every time we sell a unit. This is what we can use to build our business or to pay ourselves or to do something else with those dollars to scale that business. One unit, monthly revenue, this is what we're about to start talking about because we need to connect all the unit economics to the sales volume. You've calculated the profit for one unit. Now we need to zoom out and ask, how many units do I realistically need to sell every single month? Is my revenue steady or seasonal? What does this look like over an entire year as well? So if we look at your revenue type, depending on what it is you do, if you live in the Midwest or somewhere where it snows, you're probably not detailing cars during that time. Maybe you're shoveling snow because you're an entrepreneur. You switch it up. You do something different when the seasons change. But let's say that it's summer months and spring months and it's nice weather out and you are now detailing cars. Cool. You may have a seasonal type of business versus a year-round business, which is, let's say, a coffee shop. Or maybe it's some kind of a delivery service. This could be a year-round versus seasonal revenue type of strategy. All of this is in the guided notes. Next up, we need to estimate some monthly sales. How much revenue will you actually make? And this is obviously hypothetical, but it gives students this real experience of kind of putting their hands into doing some math. So we need to estimate our monthly units sold. How many units does your business realistically sell in 1 month? Before we choose a number, think about this. How often do customers buy from you? Is it a one and done? Is it a repeat business? Is it a subscription model? Is demand steady or is it seasonal? Are there any limits on time, inventory, or capacity? Think about some of these guiding questions. How many days per month does my business actually operate? How many units do I sell per day or per week? Are some months busier than others? Then we're going to organize our estimated numbers on the next slide. And so if you have access to these slides, there's a hyperlink here as well as in the notes where you can click on it. You'll have access to this guided graph that you can add in as you look up at the top section. It says what months are there, and then you will add in each number that you think that you'll sell in each month. So for example, in January, this business is projecting to sell 22 units of whatever it is that they're selling. And then they go on, and as they adjust that, the graph will automatically populate the bars because I've built this spreadsheet so that it will do such. From here, it'll allow you to visualize your sales patterns across the year and identify whether your revenue is steady or if it's more seasonal. In this particular case, you can see stuff starts to get busy in March, tapers back down in April, and then it really starts to ramp up. This is your first year sales projection, so it is, sorry about that, it is our first year sales projection, so it's quite possible that this will continue in that vertical rise, which is wonderful for our business. Next up, now that we know how many total units it is that we've sold, because you can see it right there in the top right corner, the total estimated year units, we can now start to solve for gross revenue. So if we know how many units we sell in a year, we just need to multiply that by the sales price. However much we sell it for one unit, multiply by the total number of units we sell in a year, that gives you your gross revenue. There's more details on this slide. Let you read that at your own time. Next step, we need to calculate for our net profit. This one is pretty straightforward. I've actually updated this slide since. I see that the step 2 information is listing break-even units. My apologies. Go into the slides and you'll see the updated version. So in order to solve for net profit, here's what we need to do. Take our total units times our profit per unit. That's it. It's as easy as that. Once we have that information, we can figure out how much our net profit is per year. Well, what if you're operating at a negative? Or, for example, if we figure out that the amount of units you're selling is just not enough, this is what we do with a break even unit. And in this, or for solving for break even, we take the selling price of our unit minus all the variable costs per unit, that equals our profit per unit. Now that we have that, we take our monthly fixed costs divided by profit per unit, tells us our break even units. Well, what is a break even unit? It's the number of units that we have to sell each month or year in order just to break even. Doesn't mean we're making money, doesn't mean we're losing money. We've now broken even. Anything we sell in addition to it is money in the bank. Anything we sell short of it, we're losing money. We are not profitable. So if break even units are higher than your monthly sales, your business is going to lose money. This is the quick fact check here. Think like a real business owner and fix the problem. A lot of students will find themselves in this situation. They're going to have to do a couple things. One, cut costs. Perhaps they have to reduce fixed expenses, get rid of the rent, go to a smaller building, decrease subscriptions, payroll, lower your material costs, simplify your product, increase revenue, raise your selling prices, improve your marketing, and sell to more customers. Now I give students a break-even stress test. This is the example where they can walk through every single step as to figuring out if, in fact, their business will be able to perform as stated, and if not, they need to go back and make adjustments. Once we've done the adjustments, I have my students do this stress test handout. They finish all of their documentation. Once they've done their documentation, they hand it off to another group to peer review it, just like a real auditing team would do with a CPA or a accountant. And in this case, once we have that, I also throw in a couple curveballs, but you'd have to see that in the notes because otherwise my students will see this in advance and know what to do. That bell means it is lunchtime. I've got to go. Thank you for teaching, in my opinion, the most valuable class on campus.